Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Friday. We've reached the end of the week in one piece. This is Peter Lewis with Money Talk. Please look the programme up on social media. On Facebook, the page is Peter Lewis Money Talk. On Twitter, you can find me at Money Talk R3. And my website is peterlewismoneytalk.substack.com, where you'll also find my daily newsletter, which is full of business and finance news from around Asia. This podcast is on Spotify, Google Podcasts, and also on Apple Podcasts, where it's one of the top 10 most listened to financial podcasts here in Hong Kong. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. Here are the business headlines for the 16th of June. The European Central Bank has raised interest rates by 25 basis points and signalled that it will increase them again in July, warning that inflation is far too high. And in conjunction with raising the benchmark deposit rate to its highest level in 22 years, the ECB raised its inflation forecast and trimmed its growth prediction for the next 3 years. The People's Bank of China has announced a 10 basis point cut to its key policy rate in a move that highlights growing concern over the state of the economy. The medium-term lending facility was cut from 2.75% to 2.65%. That's the first reduction in 10 months. China's economy showed further signs of weakness in May, with officials becoming increasingly concerned by the slowdown. Retail sales rose 12.7% year-on-year, below expectations, but that figure equates to a seasonally adjusted decrease in month-on-month sales. Industrial production rose by 3.5% in May year-on-year, but this was below estimates for a rise of 4.1% and down from 5.6% growth in April. Investments suffered a broad-based decline. Investment in real estate slumped 7.2%, accelerating to the downside from a decline of 6.2% in April. And the youth unemployment rate for those of the population aged 16 to 24 climbed to a new record high of 20.8% from 20.4% in the prior month. US retail sales defied expectations for a contraction in May. Sales, which include spending on food and petrol, unexpectedly rose 0.3% month over month in May, following a 0.4% increase in April and beating forecasts of a 0.1% decline. But new applications for US unemployment aid, which is a proxy for layoffs, remained at their highest level since November 2021 last week, coming in higher than economists had expected. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Tim Huxley, Chairman of Mandarin Shipping. With a view from Australia is Toby Lawson, CEO of Statton Partners.
Peter Lewis's Money Talk.
On Wall Street, the S&P 500 and the Nasdaq rallied for a sixth straight day on hopes that the Fed's rate hiking cycle is nearly over. The S&P 500 climbed 1.2% to finish the session at a fresh 13-month high of 4,426. The Nasdaq Composite gained 1.2% to close at 13,783. The Dow added 429 points, or 1.3%, to close at 34,408. Thursday's gains brought the S&P 500 and Nasdaq to their highest intraday levels since April 2022. And from its October closing low, the S&P 500 is up 23% now, and it's also risen 15% year to date. The Nasdaq is up more than 31% in 2023. Treasury markets are not buying the hawkish dot plots from the Fed, which show 2 more 25 basis point rate hikes before the end of the year. Treasuries rallied and yields fell after the jobless claims report showed signs that the tight jobs market is easing. The 2-year yield was 6 basis points lower at 4.65%. The 10-year yield fell 7 basis points to 3.72%. And the US dollar index tumbled 0.9% Thursday to a 6-week low on a range of factors, including Jerome Powell's dovish press conference, a hawkish ECB, elevated jobless claims, soft import-export prices, US retail sales cooling, and some mixed Fed surveys. The sell-off accelerated after the ECB rate decision, which hiked by 25 basis points as expected, but increased its headline and core inflation forecasts. And that was the biggest sell-off in the US dollar since early February. And the Chinese yuan saw huge intraday volatility. It reached a high of 7.19 renminbi after the announcement of the PBOC's MLF cuts. That's the weakest since November 2022. But it then surged higher as the dollar collapsed, ending the day in onshore markets 0.6% higher at around 7.12 renminbi. That was its biggest one-day jump since March. And in Hong Kong, stocks rebounded after they snapped a 5-day winning streak on Wednesday. On Thursday, the Hang Seng rose 421 points, or 2.2%, to 19,829. The tech index soared 3.6%. The Hang Seng China Enterprises Index, which tracks mainland Chinese companies listed in Hong Kong, surged 3%. Chinese property stocks rose after the PBOC interest rate cut. On the mainland, the Shanghai Composite climbed 0.7% to 3,253, and this morning, futures markets are suggesting the Hang Seng will open 140 points higher. That's a gain of 0.7%. And you can get more details on the latest market movements in my daily newsletter, which is at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Friday morning guests. We have with us, as always on a Friday, Francis Lun, who is the CEO of GEO Securities. Morning, Francis.
Good morning.
And also joining us, Tim Huxley, who is chairman of Mandarin Shipping. Nice to see you again, Tim.
Good morning, Peter. Great to be here.
Thank you. Let's just highlight some of this activity data that came out of China yesterday. It showed further signs of weakness, and officials are becoming increasingly concerned by this slowdown. First of all, retail sales, they rose 12.7% year on year. That's in part because of base effects when compared with a year ago when lockdowns were in effect in Shanghai. But the figure equates to a seasonally adjusted decrease in month-on-month sales and shows that the reopening momentum is fading. China's industrial production advanced by 3.5% year-on-year in May, easing from a 5.6% rise in April and slightly less than market forecasts of 3.6%. It was the 13th straight month of growth in industrial output, but the softest pace in 3 months, mainly due to a slowdown in manufacturing activity. Investment in real estate fell 7.2%, accelerating to the downside from a decline of 6.2% in April. And China's surveyed urban unemployment rate stood at 5.2% in May. That's unchanged from April's 16-month low. But listen to this, the youth unemployment rate for those of the population aged 16 to 24 climbed to a new record high, 20.8% from 20.4%. Francis, we thought the numbers weren't going to be good. How do they compare with your expectations?
Well, worse than expected. I think they really have to do some hiring program. Just not sending the young people to the villages and do farming. I think they have to urge the big techs like Alibaba and Tencent to hire people, or they send them to Hong Kong. Hong Kong needs about 100,000 people to fill vacancies.
That's a good idea.
Yeah.
But this youth unemployment rate, that's a big problem, isn't it? That's a real drag on the economy.
It's going to be a political problem if they don't try to solve it soon, because they've been trying to micro-treat the economy, like cutting interest rates, things like that, but they don't work. I think you need some really drastic program to really tackle the problem.
Tim, in your business, in the shipping industry, you're sort of at the cutting edge of this, aren't you? You tend to see first slowdowns in trade and slowdowns in the economy. How does it look from your perspective, the state of the mainland economy?
I think overall we were our expectations with the opening up and the ending of COVID restrictions, they were a bit optimistic by all accounts, and that hasn't come through. And so sentiment now is pretty negative. Volumes are still increasing. The amount of cargo moving in there is going up. Exports are down, and this unemployment figure. These are the key figures. I was talking to the CFO of one of the leading container lines the other day, and they said doesn't matter where it is in the world, you watch the employment data. If people are employed, they're getting paid. If people are getting paid, they're going to spend money. If they're spending money, that means things have to be manufactured and things have to be shipped. So unemployment data is really important, and this doesn't look good. But we've got a lot of other things going on as well, which slightly compound these problems. I mean, shipping is suffering from interest rate increases. There's a fairly healthy order book of new ships coming in, which is, in bulk carriers, it's about 10% of the fleet's on order. So that's sort of reasonably manageable. We've got a big replacement program, but the problem is we've had actually a couple of good years. Shipping had a good pandemic, and there was a lot of money made. So ship owners are sitting on quite a lot of cash available, but the problem is, what you really hope is they don't all head to the shipyards. Most shipyards are full, but shipping markets, in the main, you look back over decades, they're killed by overcapacity, and that is the risk we run.
And you're seeing and feeling this slowdown in exports from the mainland. We're seeing it in the figures now, aren't we? That exports declined sort of sharply. Is that being reflected in your business?
I mean, container rates are down, and also it's imports into China. That's really significant, because that's really the bellwether. That what leads. If you're bringing in more iron ore and coal, then you're going to be making more stuff. So then you can see that point.
And then you export more afterwards.
Absolutely.
Yeah.
So the slowdown in construction, that has a huge impact on iron ore and coal imports, and that affects the big bulk carriers in particular.
Francis, it's been reported that China officials, senior Chinese officials, they're having urgent meetings with business leaders, with economists on how to sort of revitalise the economy, and they're asking them in particular what can be done to try and generate growth, to try and get consumption back up again. If you was in that meeting, what would you tell them?
Well, create some jobs program for the young people, especially the fresh graduates. There are maybe 2 million of them unemployed right now. Just create jobs, and government subsidize half the salary. That's what some governments do anyway. I think they need to do something like this instead of just relying on the economy to right itself in the long run. That is not going to work, because the political risk is much too high. But I don't know whether they will do it. That's an open question.
They don't like putting money in people's pockets, do they? They're not doing what Western governments have done, or by giving handouts or consumption vouchers. They just don't like doing that, do they?
That's right. At least in Hong Kong, the government gave us $5,000 each. That's what they need to do anyway.
Yep. And these interest rate cuts, 10 basis points here, 15 basis points here, is this just tinkering around at the edges? It seems to me that it's not going to make much difference.
It's like China's real estate market. No matter how many interest rates cuts you have, people expect the property prices to go down. They're not going to buy property. So you have to get to the core of the problem, which is a lack of demand. The real estate market is the overborrowing of the property developers. You have to solve those problems first.
Tim, if you was in this meeting and you was asked your ideas to stimulate the economy, restore confidence in the private sector, revive the real estate industry, what would you tell these government officials?
I totally agree with Francis that getting the younger people into work is critically important, because that really sort of sets the tone for the mood of the whole economy. I mean, new generation coming in gives people that sort of positive sentiment. But are we going to be able to sort of stimulate demand if that demand just isn't there? I mean, we've got too many new properties and everything in China, and have people actually acquired enough stuff? Do we actually all need another Tesla or whatever? So are you actually going to be able to stimulate that demand? What is it that people actually need? I mean, there are all sorts of crises. I mean, we've got a food crisis. I mean, and with the war in Ukraine is having an impact on so many different areas of the economy. And I think that overall, That's I referred to it earlier about sentiment. People at the moment, they just don't feel good. I've never felt more uncertain about making an investment in any particular sector at the moment.
Really?
And so
Okay.
the easiest thing to do, and it is making a decision, the easiest thing to do in many respects is to do nothing. And that does not really help stimulate the economy or drive jobs.
That seems to be what a lot of businesses are saying, and you see it in the
Yeah.
figures as well, in the fixed asset investment numbers and elsewhere. Businesses just don't seem to want to invest at the moment, which is a sort of a bit of a damning indictment of the state of the Chinese economy, isn't it?
Well, I think, and it isn't just China. I mean, China obviously is critically important in shipping. I mean, China accounts for about 50% of global seaborne trade in one form or another. So it's absolutely vital, but you just don't at the moment have, as I say, that confidence for anybody to actually go out there and commit. And with the higher interest rates and everything, because if we look back, 2015, 2016, we had a really bad shipping market, but we had low interest rates. Now, you've got earnings today at or below what they were then, but at the same time, you've got much higher interest rates. So it's pretty tough going for everybody out there.
One of the things people have been saying is that what they would really like to do, the Chinese government to do, is to try and ease up on this central command and control economy where companies are so directed into doing certain things that they lose the ability to be entrepreneurial, to develop, to try new things. It's really stifling innovation, and that in turn stifles growth. So companies are saying, and particularly private companies, because if you look at the difference between the performance of private companies, which is 80% of employment on the mainland, and state-owned companies, massive difference. Private companies really feel quite depressed at the moment. Do you think, I mean, I know it's one of those things that's sort of got a very big political element to it as well, but is that going to be the solution? Will it happen?
Well, I doubt that they can do it because they want to put the party into everything. They want the party to be paramount. And if you listen to the senior officials, they talk, and they always say the party this, the party that. And I think the Chinese government tried to put a Communist Party official into Volkswagen, and Volkswagen threatened to pull out of China completely. And only then they stopped it. But at Alibaba, Tencent, every other company, they have a Communist Party official there.
So that stops the company really thinking about the decisions we take rather than being in the best interests of shareholders or of the company. They're more in the interests of, the political requirements from Beijing.
Yeah,
so
definitely. They want to appease the central government more than anything else because they don't want to do anything that the central government does not like and getting fined. And that's what happened to Alibaba.
So this regulatory sort of crackdown
this
is really
overkill.
What do you think, Tim?
Well, Francis, what are you saying? Just let it run like Hong Kong.
Well. Look at Alibaba and Tencent for 20 years from 2000 to 2020. They gave them a free rein. They do anything. They do everything. They become the third and fourth largest listed company in the world. And after that, what happened?
Yeah, I mean, I think we all know. Prosperity, that sort of keeps everybody happy, and that rules out social unrest or anything like that. I mean, let's not go into that sort of specific area. But I think that, yes, you have to give companies a free rein and not interfere with them and let, go back to Margaret Thatcher, the market is what it is, and you've just got to let that run its course. We are in a downturn. Downturns happen. You do not have consistent growth for decades on end, and you need that adjustment. And as a result, the cream rises to the top. The stronger, the better run companies, the companies that have got a good position, have got good products, good marketing, they will rise to the top. And I think that, yes, I think 2024, we should see a bit of a rebound. As a bit of stimulus, that will come through and that will help. We have reduced interest rates coming in at the end of the year. We hope that would all help. And then you will see a lot of these companies that are strong, good, strong management, decent products, and good presence in different markets, they will rise to the top again.
But right now, we need government action in China because the youth employment is going to become a political problem.
I absolutely share your view on that. That's one that really does need to be addressed, and we've seen this happen in other countries.
Arab Spring was caused by youth employment.
Let's really hope that they can actually address that. But you have to look at it. I mean, you look at the UK, for instance, again, there we have this massive influx of new graduates coming out of universities. One of the problems there, though, is that everybody was able to go to university. And now their expectations are so much higher. So in many ways, we're actually producing too many overqualified people with degrees in subjects that are not relevant. I mean, I don't think there are so many sort of useless degrees being dished out in China as there are in maybe the UK. But
that's the problem with China right now.
So there's too many graduates is really the problem.
I think that is one of the problems.
The problem is, though, once you've got them, you can't get rid of them again. You can't send them back and say, we're taking your degree away. So.
You can't take away a degree. But, I mean, when you sort of see, I think it was a university in Glasgow giving a degree in Rod Stewart studies or something. I mean, let's just try and keep everything relevant and make sure that people come out and make a contribution to the world.
I'm signing up right now. But maybe are we being maybe a bit too gloomy? I mean, if we look at it, the economy is still growing. It's still on track to achieve 5% for the year, or it can still achieve 5% for the year. Maybe it's not quite on track. But
Peter, you're absolutely spot on there. We've still got growth. And it might not be the spectacular growth we've had in the past, but I tell you, I'm a lot happier to be out here than I would be sort of being in Europe or the States, where I just think there are some really fundamental problems, and a political system that is more focused on the next election and keeping the jobs of the politicians, rather than here we can actually take a slightly longer term view and address some of the structural issues that we've got.
That's really a quite good observation.
And what about consumption? That's the thing that officials seem to be most concerned about, isn't it? Getting consumption up. The retail sales numbers, well, they were 12.7%, but the only problem with that is that you're comparing it to a terrible time a year ago when Shanghai was in lockdown, and it can't do anything but sort of rebound. And if you look at it on a seasonally adjusted month-on-month basis, retail sales are now declining. So I suppose the concern is that was really almost the only functioning part of the economy at the moment, because exports have slumped. You're seeing investment declining. So how big a concern is that? What can the government do to try and get consumption back up?
Well, I think one of the biggest problems China is facing is that the richest 100,000 people in China all want to get out of China and get the money out. I think that is a really major problem, because every one of them is a billionaire. And if you take the money out of the economy, you're losing a lot of consumption. I think what the government better do is try to soothe the anxiety of these rich billionaires rather than the ordinary people.
Really? So you think that should, but it's not politically. That's very difficult to do, isn't it?
Yeah, it's not very difficult. It's a very touchy subject. I don't know how you can placate these billionaires.
Well, I saw that survey. It showed that that China's got the most number of millionaires leaving now the country. Whereas a country like India, although it does have people leaving, it creates far more millionaires than those that actually go. So,
but then India's coming back from a slightly lower base. I mean, China sort of shot ahead in its economic development, and so I mean, I'm a great believer in the Indian economy, and I'm sure that will continue to produce plenty of billionaires. But I think, I agree with Francis, you've got to keep your key people who are the entrepreneurs who have actually built these companies like Tencent and Alibaba and all of these others. But at the same time, you've got to balance it with making sure that you are lifting other people out of poverty and getting sort of the graduates into employment, because I mean that's your future, and that's also where you can have the real tensions. Remember, and there's a lot more of them as well. Yeah,
actually, Tencent and Alibaba last year pledged 100 billion yuan to invest in social programs. I think they can use the money now just to create jobs for the youth, let them do whatever, they clean the streets or whatever, give them some pay.
And there is this big contrast, isn't there, where here in Hong Kong, we're looking for workers. We're almost pleading for people to come to Hong Kong. And there on the mainland, you have this surplus of sort of unemployed people who are doing nothing. You would think there must be some way of sort of reconciling that. Well, where does Hong Kong fit into all of this? We had these numbers, 10 million arrivals in Hong Kong now for the first 5 months of the year, although that is about 40% of where we were pre-pandemic. Mainland people made up about 80% of those coming to Hong Kong. Where do you think Hong Kong fits into all of this between global growth slowing and the mainland slowing?
I'm pretty upbeat, actually, having seen a lot of things going on in Hong Kong and having had a lot of people beginning to come through Hong Kong again from overseas. Yes, the majority of our visitors are coming from the mainland, but if you get the sort of long-haul visitors, which is still very much reduced, and you look at some of the traditional busy business hotels, they're still running at very low capacity. But people are coming here. People are wanting to engage with people. People are talking. I was talking to somebody on Monday, and they were saying, I think we should actually relocate our office to Hong Kong. And you're thinking, well, we haven't had that for 3 years. So there is still a really positive vibe about this is the great place to do business, and especially if you want to do business in China. Let's not get too depressed, guys. We really, the numbers don't look good, but the bottom line is China and this part of the world is still going to drive growth. I was being a 28-year-old sitting in gloomy Europe or whatever, the opportunity to come out here, you'd grab it with open arms, and I would say that to anybody now.
And even today, you would still do that.
Today, definitely. Things have changed. You do actually need a better skill set you did than when I came out here. Bit of language skills for sure. No, this is still where I believe that there is a huge opportunity. Will different industries? Yes, sure. And you've seen it's coming back with people who moved to Singapore are now saying we might relocate back to Hong Kong, and that's I didn't expect. I thought we'd lost that for good, but now there are a lot of people actually saying, costs in Singapore. Hong Kong is still just, in my view, it is still the best city in the world to live in.
What do you think, Francis, for Hong Kong?
That's really nice to hear, because we lost so many people to Singapore already.
Yeah.
So we'd love to welcome them back. I think the important thing is create more jobs for the youth in China. Just bring them in and let them work in the restaurants and hotels, and because they need the most people.
I think that is definitely the case of we've got chronic shortage of people in the hospitality sector in particular. But importing people from mainland China, there are a lot of hiccups there. It is incredibly difficult and expensive to resettle in a new city. Even if you're just transferring within the Greater Bay Area, it's still a big upheaval. And we've seen that, and it is difficult to integrate into a new city, and especially if you're in one of these jobs. It's a job, but it's not a particularly well-paid job. I think imported labour from the mainland. You have to
provide housing for them.
Yeah,
I think that's the important thing.
It's not really the ultimate solution.
Yeah.
And you've got to train them as well, haven't you? For some of these jobs, you can't just put someone in a bus and ask them to start driving it. You've got to train people to do some of these jobs, even if we want to be a crane driver or whatever it is, and that's all going to take time, isn't it, as well?
But we talked about the number of graduates coming out. Now, does a graduate from a university in China, do they want to be a crane driver? And that's it. You've got to manage people's expectations. And if you look at it, a lot of people coming out of university now, their expectations and their sense of entitlement is so much higher than it maybe was in the past. And that has got to be managed better.
But now blue-collar jobs are paying better than white-collar jobs.
Sure.
So they have to change their expectation.
So where's the government going to find all these people that it's talking about bringing in certain sectors where there are shortages? I mean, they've got some quite high numbers for those sectors. If they don't come from the mainland, how do you persuade people to come from Canada or the US or Europe to come here?
I have absolutely no idea. I mean, I think there's going to be a real struggle. And this is going to be an ongoing problem, and it will fuel inflation. Wage levels are going to go up. When what you have to pay.
Housing is going to go up. Housing is the biggest problem in Hong Kong.
Yeah.
So you have to build dorms for them. You have to house them. Just like put them in the Lantau Island.
I mean, people have got a better. If they're going to move to Hong Kong, I mean, it doesn't matter. It's the same as it always was with everybody who's come here, and we're all migrants in one way or another. People do have an expectation. They come to Hong Kong for a better life, and living in a dormitory on Lantau is maybe not what their actually expectations were.
Yeah, it's only a stopgap measure anyway.
Yeah.
Well, look, I didn't want to be too gloomy today because I knew the data was going to be bad, but I found some good piece of data for Hong Kong to ask you about. The Hong Kong Trade Development Council Export Index, it's risen to a 2-year high.
Wow.
It's 47.8 in the second quarter. That's an 8.8% rise. It's the second quarter now of improving business sentiment among Hong Kong exporters. 5 of the 6 sub-indices also improved there as well. Sentiment towards Asian, Japan and mainland China also improved. There was one little cloud, and that is that concerns over economic risks are rising. The majority of respondents, about 2/3 of them, recognise the risk of an economic slowdown or a recession in their overseas markets as the biggest challenge to their export performance over the next 3 months. But nevertheless, Tim, it's good news, isn't it? I mean, this is a forward-looking sort of indicator.
Yeah. It is. I mean, although you ask people, what are you exporting from Hong Kong? And we don't make a lot of stuff here.
We're re-exporting, aren't we?
We're re-exporting. So, but any growth in trade figures or whatever, I mean, it's the trauma of the last 3 years, I do sense, is gradually receding. There are certain scars which are going to be borne for many, many months to come. But definitely, we're getting back Hong Kong is getting back its mojo, for sure, in all areas. And so I think that, yes, those figures there, that's at least one piece of positive news. I mean, if we can keep things moving in that direction, then I have every confidence in Hong Kong. But our economy is so dependent on the mainland that really developments there are going to be fundamental to the prosperity of Hong Kong going forward.
Yeah, definitely. We really depend on Chinese exports going through Hong Kong.
So, Francis, what do you make of all these interest rate decisions this week? We've now got an interesting divergence. We've got the People's Bank of China cutting interest rates. We've got the Fed on hold, although they did say that, they're expecting 2 more rate hikes this year. We've got the ECB raising rates and saying they're going to have to do it again next month as well. This is rather an odd divergence, isn't it?
Definitely. In Europe, they still haven't tamed this inflation.
They're behind the curve in Europe, aren't they?
It's the Ukraine war. I think they can get over it, but I think they manage it much better in the U.S. I think at least gasoline prices is coming down. The biggest problem is that the rents are not coming down yet. So only office rents are coming down, but home rents are not coming down. That's the one key component of the CPI. So I think maybe people were betting on the Fed not raising rates again. And I think many people are thinking the interest rates have peaked in the U.S. That's why you have this rally in the stock market overnight.
But they've been fighting the Fed all year, and all year the markets have been wrong, haven't they?
Yeah.
Well, the market has been much stronger than expected anyway.
But I mean, again, I turn to China. I mean, it is so important to the global economy, and they've got lower interest rates. You haven't got the inflation problem that the rest of the world's got, but still they've got these fairly dire economic problems coming through. Is there a quick solution to that? I'm not 100% sure, but there is this, as you say, the divergence between these economic issues we've got out here and what's going on in the West, and will there be significant events? I mean, obviously we're watching very closely what's happening in Ukraine and the knock-on effect that has. Will there be something that is actually going to sort of give a really positive feel that we have begun to turn the corner? These, as I said right at the start, the positive nature of when lockdowns, etc., eased in China, we maybe over-egged that a bit, and it hasn't turned out, the growth and the return hasn't been as strong as we expected. But I think that's because for so many years we always looked at this sort of stratospheric growth rate in China. I mean, most countries in the West, I mean, they'd be delighted to have China's growth rates.
Right. And China's inflation rates.
Yeah.
do you think inflation is under control in the West? I mean, it's off its highs, isn't it? But it's still higher, way higher than their target.
Yeah, I think it will take 2 more years to reach the 2% inflation rate in the U.S. Because you have a structural problem with the rents and things like that. So it's difficult to take.
But people have also changed their approach. I mean, people now, if you look back at the good old days of recessions in the 70s, I mean, people didn't have so much debt. There was less household debt.
That's the thing, isn't it?
And you look at the way people's mortgage rates are going up in the West, in the UK in particular. I mean, these are crippling, and people are, and wages are not, even though wages have been going up at quite a high rate, they're not matching these increases in certain household costs like accommodation, food, all of this. This is really painful for a lot of people, and they don't have the reserves, the savings, and it is so much easier still to borrow money.
Okay, well, look, thank you very much. It's great to hear your thoughts this morning. Really nice discussion there. Have a great weekend. Thanks for coming in. That's Tim Huxley, who is chairman of Mandarin Shipping, and Francis Lun, who is the CEO of GEO Securities. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Australia. Morning, Toby.
Good morning, Peter.
Now, we had some employment data out of Australia earlier this week, which was really very sharply surprised to the upside, didn't it? Employment in Australia surged by almost 76,000 jobs to 14.10 million, easily beating market forecasts. It was the largest gain in employment since June 2022. It looks like Australia's in the happy position of creating quite a lot of jobs.
Yeah, very surprising number. We did have a bit of a softness in April, so it's a bit of a rebound, maybe. So maybe a little bit of a reflection of that. But most fascinating was that the majority of those jobs were full-time jobs, which is always a stronger indicator of employment in the labour force market. Participation rate was slightly bigger as well, so people feeling like the market is still very tight when it comes to the labour force. And as well, you've seen wages being pushed up, particularly for the lower paid workers in Australia, with some of the Fair Work Commission putting up wages across that sector. So all of that points to a sort of fairly resilient economy, but at the same time probably potentially one that is going to continue to be fighting inflation a bit harder than maybe some other economies.
I suppose that's the one downside to this, isn't it? Because employment is one of the key metrics that the Reserve Bank of Australia looks at when it's deciding on interest rates. So presumably these strong employment numbers raise the chance that the RBA could hike rates again when it next meets in July.
Yeah, and I think that's probably the story out of this labour force is that, we're seeing, I think, on the ground, and, if you talk to in our space, you talk to headhunters, you talk to, you see some reflection of real time. There is some softening of the labour market. It's certainly loosening up at some level, but clearly as a lag indicator, it's still pretty strong. So the Reserve Bank will be looking at that. As well, you're going to have, migrant numbers are booming in the next 12 to 18 months, likely to probably add pressure to the labour market there. So that, in that sense, the Reserve Bank maybe see that this is the peak of the positive in the labour market. Against that, of course, you've got higher energy prices, you've got wages going up, probably ahead of productivity. Housing prices have spiked again a little bit, at least turned positive. So on those factors, the Reserve Bank are probably thinking we've still got some work to do. Now, if you then look at the level of relative interest rates, Australia at 4.1%, the US at 5.25%, Europe at 4%, UK at 4.5%. There's probably a little bit more room for Australia to raise rates, even on a relative basis. So I suspect the Reserve will be looking closely at another hike in the coming months.
I suppose if the RBA looks overseas for some guidance or looks to see what other central banks are doing, their heads are going to be spinning this week, because we've had in the space of 3 days the People's Bank of China cutting their interest rates, the Fed staying on hold, although the policymakers there on the FOMC were indicating maybe 2 more rate hikes this year. And then we've had the ECB actually raise them and make it quite clear they're going to do it again in July. We're getting an increasing divergence, aren't we, between what central banks are doing now?
Well, I think the couple of things. So if you take China's case, the economy is not really kicking as they had hoped. And so I think that, they're going to try to accelerate growth and activity through the domestic side, through some policy moves. So that's probably a bit of a surprise that they haven't really bounced out of COVID as much as they expected. And I think for US and Europe, I think we're sort of heading towards the terminal rates of where, we see the peak in the cycle, maybe in terms of short-term interest rates. So in the US, they're probably ahead of the mark. So they're hitting to that pause level. I thought it was a bit of a hedge bet from the Fed. They did pause, but then sort of took it back with 2 hikes, potentially back in the later part of the year. I was just having a look at the numbers. I mean, the inflation numbers are better in the US than anywhere of the developed economies in terms of trend. They've actually come off. The PPI numbers are really quite soft this week, and against that, some of their activity numbers, like the Philly Fed and activity indicators, are showing that the economy has slowed. So they're probably in slightly better shape. So 5.25 looks about the terminal rate maybe in the US, with maybe a bit of move either way. In Europe, it's 4%. And as you quite rightly mentioned, the ECB were quite clear to say that they're not done yet. So what's the terminal rate for the European Union and the Euro area is probably maybe 50 basis points from here. So from an Australian perspective, cycling that back, we're at 4.1. Historically, Australian rates would probably stand at a premium to US rates historically. So there's a big gap. But I would suggest, the terminal rate in the Aussie is probably 50 to 100 basis points from here, depending on how the economy performs. So, it's a conundrum. But I think what you're seeing there is towards the end of a cycle or towards the peak of a cycle, you start to see this disparity come through.
The ECB, they're behind the curve, really, aren't they? Because although everyone's focusing on US inflation, what we shouldn't forget is that Eurozone inflation is actually higher than it is in the US. So presumably the ECB, out of all of them, has got further to go. Yeah,
well, so 6.1%. And if you're targeting 2%, 2 to 3% as trend, then they've got a long way to go. US, on the other hand, is heading back towards the 4 handle in terms of inflation. So, absolutely. So what did the ECB, they forecast 5.4% this year, inflation, 3% in 24, and only target 2% by 25. So rates are going to go higher there, and they're a bit behind it relative to US, and probably stay higher for longer. Against that is the European economy probably is underperforming relative to the US. Technically, you saw recession in Euro area driven by Germany. So there's a slightly different picture in Europe versus US in terms of relative economic performance.
The worrying thing, I think, was from what Christine Lagarde said and from the ECB statement was that, as well as raising interest rates, they've also raised their forecast for headline inflation and core inflation, and also downwardly revised their expectations for economic growth. It's not a very good mix, is it?
Right now, no. I think that the clear message, I think, from the ECB was that inflation is the target. They have to get inflation down. And I think this is really reflective of language that central banks need to use. And it's something here that the Reserve Bank hadn't communicated exceptionally well in Australia about the need to be pushing inflation down aggressively, and therefore the implications of that is actually to reduce demand and potentially push economies into a recession. There's no choice. And the choice is that if you want to get inflation down, then you have to slow demand, which means economic activity can go into reverse for a period of time. I think the communication around that's got to be clear, and I think the ECB were really quite determined not to let the US interest rate hold have any, flow-on effect into Europe. So I think the messaging was pretty tough, and it's no surprise that when you're raising interest rates aggressively that you're going to slow growth. It's really about trying to get that landing, that soft landing. We talk about that all the time, and US seems, so I want to be presumptuous, but it's almost like it's working a little bit in the US right now.
The US decision, the Fed decision, it was a bit of a hawkish hold, wasn't it? Because although they left rates unchanged, the dot plot was revised upwards. So now you've got the FOMC basically expecting 2 more rate hikes before the end of the year, 225 basis point rate hikes. Do you believe that? Because the markets are sort of are rather sceptical about it, aren't they?
Well, the equity markets are running hot, right? If you look at it, 21%. I think the S&P year to date growth, Nasdaq 36%, even the Dow's up 16%. So the equity markets are probably a little ebullient in regards to that particular outcome. The data's a bit mixed. You saw Empire Manufacturing data in the US that was growing, whereas the Philly Fed index was worse than expectations. These are 2 good indicators for economic activity in the manufacturing side. Retail sales are 1.6% year on year versus an expectation of 1%, so that's relatively positive. So I think right now it's the data's a bit mixed. The employment data is still, the labour force is still fairly tight there, even though anecdotally you're seeing a lot of job degradation. So I think it's still a bit of a bet, and I think the equity markets might be a little over-optimistic as to where the Fed is trending. One thing I think you can say for sure is that the forecast of lower rates into the new year are probably unlikely. And that rates are going to stay higher for longer.
Well, they've priced that out now, the markets, where, at one point at the beginning of the year, they were saying more than 100 basis points of rate cuts by the end of the year. They've priced that out, but now they seem to be saying we don't believe that there's going to be 2 more rate hikes this year. And I'm wondering what the Fed is trying to achieve with this sort of 1-month pause by saying we're on hold for a month, but it's quite possible rates are going to go up again next month and they're going to go up twice by the end of the year. What's the sort of aim of that?
Well, that's about managing expectations, because one thing about inflation, as we always talk about, is it doesn't want to get entrenched into expectations. So, the fight's not over in regards to inflation, albeit a much stronger picture in the US right now. And I think the Fed feel that, okay, let's see how the data plays out, because some of the indicators they're seeing are lag indicators versus lead indicators. The lead indicators are showing the economy has softened, activity has slowed. Some of the lag indicators still show some strength, particularly in employment. So I guess they're probably saying, right, we just need to see if these lag indicators have the impact and we start to see the feed through that we're expecting. Terminal rate of around 5.25 is about where they were expecting, and maybe a little higher. I think they just don't want to. Well, unfortunately, they haven't had much success, to be fair, because the equity markets bounced so strongly. But they want to taper that expectation that it's we've reached the peak, and so I think that messaging was pretty clear to say, look, hey, we're pausing, but that doesn't mean we're finished.
Jerome Powell was quite optimistic in his press conference the other day. He seems to think there's still this path to getting inflation back down to 2% without having a recession or the kind of sharp downturn and job losses that we've seen in the past. Do you think he's right? Is the data supporting that view?
Yeah, right now you could you could see that optimism being rationalistic. It's not just a bit of media spin. I think there is some sense of the US economy has still got some reasonable strength, resilience to it. The labour market is still relatively tight. Also, we're seeing job losses. The banking crisis, which sort of was not really a banking crisis from a credit perspective, it was more a liquidity crisis in amongst those specific banks around deposits. So that hasn't flown through yet. The debt ceiling has been resolved for so that's no longer something in the news. Politics is not going to play out aggressively in the US over even though it's always in the news. The election's not till next year. So in that sense, I think there is some pause that that the Fed could potentially navigate a soft landing for the economy. But like economics, it's not an exact science. In fact, it's arguably not a science at all. Things we cannot prepare for and not plan for are probably ahead of us. So right now, I think his comments aren't unreasonable.
Toby, thanks very much indeed. Have a great weekend. Great to talk to you. That's Toby Lawson, who is the CEO of Statton Partners. Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Sam Favre, CEO at Mandarin Capital. And with a view from mainland China is Brock Silvers, CIO at Kion Capital. Have a great weekend.
Money Talk